but this is a dense topic. This is actually, we're going to be blunt about it. We're going to be calling it like it is. And we're also going to be covering stuff that's not easy, right? Investment metrics is the trickiest part. Of course, if it was easy, everybody's investments would all flourish all the time, every single time. So what we're trying to do today is cut through some of the clutter in the teaching or in the perception of how to approach investments in general, and help equip people with, ideally sort of the X-ray vision it takes to be able to discern between what might be a great investment opportunity and what might be something to run away from. I do see there are some questions in the chat. AdaPia, maybe if you want, interrupt me at any point. We're just going to kind of dive in, and we'll answer questions as we go, if we can, and then also we'll have some Q&A at the end. So with that, if learning about the various kinds of investments, let's say the stock market, real estate, insurance products, venture, NFTs, and crypto, if those are the ABCs of getting more fluent in finance, then learning how to actually judge whether any of those are sound at any point in time is, let's call it the XYZs. And the reason I say that is it's how you get bearings in space, right? In the confusion of time and space, how do you get your bearings around whether something is sound? How do you find your orientation? Not just, what is crypto, but which cryptos might be sound to participate in? Is it a good time to participate with crypto? The orientation that is super important above and beyond just knowing what it is, right? And so what we really want to do is emphasize that in all of this, you're really trying to get a 3D look at things, not just something on paper, not just someone talking at us, but looking at any investment in relationship to everything else. And basically, for that, we're good at this, right? As women, orientation and context are really key, and they go hand in hand. So it's not looking at something in a vacuum, but looking at it in relationship to other things, thinking in a way, if you will, in webs, which again is something we're really great at. So while we're going to fairly difficult territory now, talking about how do you know whether an investment is good or not, I just want to say at the get-go that we as women, if anything, have the ability to do this possibly better than some. So with that, AdaPia, do you want to talk about some of the basic, traditional investment metrics that are out there that people will sometimes use for gauging an opportunity?
Mm-hmm. Yeah, so we're going to start with this because there are literally dozens of financial investments and investment metrics and measures. There's so many different things. There's ones for stocks, there's ones for real estate, there's ones for businesses, there's ones for private equity, and we're not going to cover those. We're going to cover just some of the most basic ones, but at the end of the day, the most basic things are always the ones that we want to go back to, and they're the most important for us. And they can often be confusing and confused even by people in the industry who might be using them in the wrong way. And so I really want to use these as the baseline ones to know. So for example, a return on investment, this is one of the simplest measures, and it can get overly complicated, but it directly measures the amount of return on a particular investment. And that's relative to the investment's cost or to what you put in. So if you put $10,000 into something and you get your $10,000 back, first of all, and then you make another $3,000 on it, you have a 30% return on investment. And that return can be from anything. So this is just a basic metric. And there's no time involved with this. So this is just what you've made irrespective of time. And so this is the first one. This is just what my return is. I put in this, I put in X, I got Y, that's my return. When you hear the word yield, this is related to income or usually regular payments from something. So a yield is used to tell you the percent return that, let's say, a dividend or interest payment has made to you. So yield is specifically referred to around bonds or, like I said, dividends. So this is very specific, and you'll see this also on loans where you have a yield that you pay, but you can also receive a yield. The other one is cash flow. So cash flow for this is probably one that a lot of us recognize, especially if we have our own businesses. Cash flow is basically just money that flows in and out of a business. And so you might hear people say, is your investment cash flowing? Well, they're not talking about a stock. They're probably talking about something in real estate. So we use that a lot in real estate. Like, what's the cash flow? But that's not really like an investment metric. It's just telling you, is money coming in and how much money is going out. You might hear in real estate a cash on cash return, which is simply a metric that's used to measure the amount of return that you get in the first year from a rental property. Then we have the average annual return. And this is when we add the element of time to the return on investment. So usually to have an average annual return, you're looking at something over a period of time. So if it's just 1 year, that's your return period. That's also your average annual return. But if you have something that has even a 2 or a 3 or a 5 or a 10-year horizon, you want to average out what your returns were each year over time. And so this is really simple. It's an average. You add your returns from each year and you divide them by the number of years. And this is important to understand the ebbs and the flow of an investment over time, because you might make 20% 1 year and 10% the other year. Well, that average is 15, right? So it's the element of time, like in baking, especially if you bake bread, like time is an ingredient. Time is also an ingredient with investing, and it allows you to understand how an investment performs for you over time. Now, all of these and any investment metric is really a way to show us how one thing is performing relative to another. So there's no return that's necessarily good or bad, but when you look at it relative to something else, you start to understand which is better and which is better for you, right? So this is how we use them, because even, for example, if you have, like, you see this sometimes with, you see this out there where it's like the investment is only down 5%, but the market is down 15. So that's another example. They're both negative, but your investment is actually performing better because it lost less. So again, it's for comparison purposes. And the last thing is, are your returns net of fees? Now, this is where you really have to go into the fine print no matter what, because this is what's going to eat most of your returns, no matter what metric or measure you're using. So when you are looking at returns, understand, is this gross or net of fees? Super important, because that also tells you how much is being taken out in fees. And so these are just some of the basics, really important ones, simple, but the ones that you always want to go back to.
Great, thanks for that. Now we're going to get sassy about this, okay? Because we just looked at all the ways in which metrics, right, can be used to present facts, quote facts, about investments and investment opportunities. And as we hear very often, right, numbers don't lie. The data is very clear. Or do they? Because there is something very, very easy to do with numbers and data, which is to manipulate them. And so when you're getting presented with any kind of deal or opportunity, it's always very easy for it to look great on paper. The data that they'll present can look very strong, especially because it's numbers. And of course, they're going to be telling a very positive story. As a discerning potential investor or someone engaging in any way at all with finance, you need to learn how to look at the context and orient yourself around the situation to have that X-ray vision that we're talking about, because they can omit very important details. They can choose the data that they're pulling so it tells the best possible story. We all know this. We've seen it in all kinds of different sectors, not just finance. They can say something completely out of context so you don't hear the whole story and it sounds great, and because they didn't tell you the one part that's just really bad. There's even outright fraud, which is rampant, especially in venture capital, outright fraud. Right. And then there's also false causality, which is if you're a scientist sort of, and people are maybe running a faulty experiment and they're thinking that they read the numbers right, but in fact they didn't, just because they really weren't making the proper connections between things. The reality is 73% of statistics are totally false. No, actually, I'm just kidding. I just made that up. But that's, see how I said that? You believed me instantly because I was using data. So there's not a lot that prevents somebody from just making statements, making them sound really official. So of course, we have to learn how to dig a little bit, look at the vectors underneath that can help us figure out, are these numbers lying or aren't they? I want to show an example. So let's say I'm a school teacher and I want all my students to get off of screens completely. And I challenge them to have 24 hours with no cell phone, Xbox, computer, nothing at all. I want to show them how addicted that we all are to screens and that life can be better without screen time. So I'm a teacher. I have 3 middle school classes, total of 100 students. I pitch them the idea on a Monday and I say, I challenge you to do a 24-hour challenge. And then on Tuesday, I ask, how many of you succeeded? Only one kid in all 3 of my classes raises their hand. So then on Tuesday, I share additional stats about the impact of screen time and the possible negative effects on the mind and the body. And then I repeat the challenge. And then the next day I ask how many kids participated, and 5 kids raised their hands. Okay, so that was just a little experiment. And this is the graph of my experiment, okay? The no device challenge, day 0, day 1, day 2. Oh my gosh, look at this exponential growth. Look at that. Love it. It's such a success. Same exact data, literally, okay? But look at this graph. Day 0, day 1, day 2. My God, this is abysmal. This is going nowhere. I'm barely moving the needle. So what changed it? I'm accurately reporting the numbers both times, but I chose a different way of showing it. I'm showing relative to day 1, huge growth, right? But in the large picture of all 100 students, when I zoom out, I did not have a lot of impact. That's just one example of how the data can mislead depending on the decisions I'm making as to how I want things to look or how I'm choosing to interpret it, right? Because I could even look at it as half full, half empty. Oh, I'm making great progress. On day 2, many, many more kids did it. I just got to keep this up. Or, oh my God, out of 100 kids, I've lectured them for 2 days straight. Barely anybody's caring about this. So it's really, really good to remember this as we go into the next thing. So if in fact numbers can lie, right? How do we protect ourselves? My advice, this is my own personal concept, is concentrate on vectors. Now, a vector is essentially a direction in point, space, and time. So a direction taking from a point A to a point B and the sort of direction it's going, okay? So I like to look at vectors because they have a certain momentum inside of them that's harder to manipulate when you learn how to look at them. And vectors are also, they tend to help us because they tend to resonate a little bit more with common sense and also what we call trusting our gut. I think we're built to kind of understand vectors. I just think that's something innate that a lot of us, it does make sense to us. So for example, in the previous experiment, right, there's the data, which could be manipulated or give misimpressions and stuff. But what if I think to myself about the vectors and I just zoom out and I think, what is true there, regardless of any spin? Okay, well, number 1, kids are learning about screen time side effects in school. That's for sure, right? Because before I was doing anything, nobody knew anything at all. Things are different. A couple kids are learning things. That's true. A needle is moving. Some, but not all the kids are moving, right? Because clearly there's 100 kids, maybe 1 or 5, some of them are moving, a lot are not. That's true, right? That I, as a teacher, am trying again. I know that's true. I know that after I tried again, more kids modified their behavior. So maybe it's because I shared some stats. Maybe it's simply because I just repeated. I don't know, right? I couldn't take a false assumption as to what moves the needle, but I know that with me trying again, the needle is moving again, right? For the positive. And it's, maybe there's some momentum on this. That's something I could potentially say could be true, regardless of the stats. But I also have to be honest and say it's a little too soon to tell, right? 2 days in, I mean, really, is that enough data for me to write a thesis about all this? No, it's not. And to me, that seems fairly common sense and obvious. Hopefully to all of you, it does too. It doesn't seem that hard, right? To sort of strip away and look at what's real here when we're taught to look at it in that way. So again, I said what a vector is. It's a quantity. It has a direction. It has a magnitude. And in my sense, the way I explain that, it has like a momentum, okay? And it's definitely helping to determine the relationship of one point in space and time relative to another. So it's really just a quantity with some momentum taken in context, which we talked about the importance of context. So how do we get to the bottom of it with vectors? How do we, let's say someone's pitching us a deal, right? And everything looks great on paper, of course, because they chose the data that tells a great story. How do we start to look under the hood to find those underlying vectors? Well, okay, here are a few tips. In my opinion, you can't go wrong with this, okay? Number one, there has to be value being created in this equation somehow, and it has to be consistent. It's not just a flash in the pan, right? The way money works is if we create a value that is essentially impacting people for good. Sorry, I got to close my door really quickly. My Roomba was coming in. It was going to be really loud. Sorry about that. If value is us adding something that other people care about into the mix at our own expense so that it serves other people in a way, we're creating some value. And if we're doing it consistently, then, you know, that's a repeatable thing. It's almost like a scientific thing. And money will start to grow or result from it. That's just how money tends to work, okay? So this is another cool concept with money. The greater the number of people being impacted by that value, typically the greater the money that goes to it. So if you think of movie stars, the interesting thing is they do these wonderful, easy sort of lives, you know, but they're impacting us so much. They impact millions, billions of people, and they create money as a result of it. So it's not so much the effort, it's the value that they're delivering, right? And that tends to correlate to money. So when you're looking at an investment, look at the value that's being created, look at whether it's consistent, and look at how many people it has potential to impact with that value, okay? The other thing is, I like to call this ask how the sausage gets made. If someone is telling you about this wonderful opportunity and you start asking questions about it, there should be no question that is off the table. There is no question that should be dumb. There's no question that should be like, oh, that's not really important. We don't have to talk about that. I guarantee if you ask that question and they tell you it's not important and you don't have to talk about it, it's hiding something. It's probably hiding a flaw that either that person doesn't even realize exists or they do know and they don't want you to see it. There are literally no dumb questions when looking into an opportunity. And the details are actually very, very, very important. So easy red flag. If you want to get granular about an opportunity and they don't want to, walk away. Absolutely walk away. Because if the sausage factory creates sausage consistently, they should be excited to explain how. Because they've cracked the code on how to create some value and iterate that. That's why there's an opportunity here. That should be the story they're really dying to tell you, okay? And then the third is just ask ourselves, does this make sense to me? Because we tend to give our personal authority away sometimes by assuming that, you know, the men in the gray suits, this is, you know, just a cliche, but it's kind of a cliche for a reason, that they know better than we do. They're smarter, they're more sophisticated, but any good opportunity will pass that smell test, even for an office. And actually, in my belief, any good opportunity should actually, at the core of it, be simple enough that you could probably talk to a relatively intelligent 7-year-old kid and explain how come, and they would be like, yeah, okay, that makes sense. So if it's not easy enough to understand in some sense that you can see a chain of value that makes sense to your gut, it's probably not an ideal, because typically the answer should be clear. Okay. So, okay, I'm going to try to show an example of this that comes out of my industry, just to help explain the way I look at this, how that translates into evaluating options, because it's all, sounds great, but then when you're presented with a bunch of financial things, it can feel really overwhelming. So I'm going to show you how I apply this technique in my own work, just as an example, so that you can understand that this technique can be applied in all kinds of different ways. Okay. Just a little context. So what I am is a consultant, and my job at Quantum is to evaluate insurance products on the daily and figure out which carriers have the very best value in a specific category of insurance, and then help our clients get the very best value out of their insurance. So it's kind of difficult, right? Because there are all these different carriers, all these different products. And of course, they're all being sold all the time. So if I look at just the paper, every single carrier is going to talk about how great they are. My job is to have the X-ray vision to evaluate, well, which carrier actually has the best value right now, and which product is actually the best value right now. So I've had to develop this ability to kind of cut through for decades at this point now, because my job is to evaluate insurance products for suitability. All right, now don't get scared, but this is the example of one of the things I've had to do to look at the data and try to figure out where the stories tell a bigger story about what's really true. So for example, in insurance, there's a lot of different kinds of permanent insurance. There's something called whole life, which people have probably heard about a lot. There's something called variable life that will get sold sometimes very aggressively. There's something called indexed universal life. And there's also something called guaranteed universal life, but it's used very rarely. So of the three that matter most, that are sold most frequently from all the different kinds of sales agents and salespeople and carriers that you might come across in the entire insurance industry, there's a lot of different spin. And so one thing I did was, at one point, I just recently, because it was time to evaluate things again, I got some of the leading whole life carriers and I pulled some quotes. I got a leading variable life quote, and then I got a leading index universal life quote. And I made sure it was basically apples to apples as much as possible on some of the main moving parts, right? The same death benefit, different, I won't get into it, but then I looked at the numbers and how they really played out. So I could see the broad perspective of, within all the different promises, within all the different guarantees, within all the different paper on this, which ones were actually producing the very best overall value to a consumer. Okay. And it took a little bit of work, right? This is not an easy spreadsheet. Believe me, there's a lot of work. At the end of the day, I found that this indexed universal life product is still definitely the best, because in indexed products, they cut through something really strong. They don't try to tie anything to something that's going to fluctuate. They just promise guaranteed minimums. And then there's a little bit of promise that if things are doing well in the economy, you might get even better than the minimum, right? So there's upside potential, but it's very stable in that sense. So long story short, where some of the other products are doing this red line, right? This product is a slow and steady wins the race kind of thing. And it's very, very strong, because it's not only going to do just as well or better most of the time, but it's providing a kind of consistency, which is really refreshing because so many other things fluctuate. So I won't go into detail on this, but after you start to identify the vector, like, wow, the vector in this product is actually really strong because it's built in a way that's providing something of real value, consistency, and in a way of avoiding fluctuations so that on average the returns are higher, right? Then the next thing is, okay, is it real? Is it consistent? Because on paper, it could be like, yeah, we're great. We always come through on our promises. Well, no, let's look at the last 25 years or 20 years. How has it actually performed with that carrier? So I looked, and this was the actual performance versus promised performance. It lined up. Okay, good. That's good, right? Because if it didn't, we would run away. But I wouldn't even know if I didn't ask, did it match up, and is it consistent, or does it just look good on paper? So then I looked out at the big picture on this, right? And I'm thinking, okay, if this product is consistent and there are guarantees, okay, And I know that in any life insurance product, the death benefit's tax-free. So wow, from a tax perspective, that's pretty strong. Okay. The other question is, well, am I paying too much for the guarantees? Am I giving up too much upside if I'm going to direct clients towards something that's a little bit safe? Well, no, because look, there's still upside on this. So there's actually plenty of upside potential. We're not giving up too much opportunity cost for that safety that it's delivering. And then also it so happens that once I dug in on that kind of product, there are certain carriers that actually add riders that can double up as long-term care. So on top of all the other vectors from a financial perspective, there's these value adds. So I'm looking at it, I'm thinking, wow, okay, these are very, very strong. These are sausage deliverables, right? There's consistency. I can guide clients safely into this decision because I've really looked and compared. Now, the other questions to ask are, okay, it's great product. You still want to look in context, and I have to look in context for my clients. Do they have anything like it already in their portfolio, right? It's kind of like pizza looks great for dinner, but if I already ate lasagna, maybe I don't need pizza, right? Even though pizza is great. So I want to ask that kind of question. And then, of course, I need to be thinking, how does this affect my overall portfolio? How will it affect my situation? In a good way? Hopefully, yes. Great. Okay, well then great. Then this one's probably a yes. But then, of course, there's always the question of, can I even engage with this opportunity right now or not? Can I? Or is it going to come at the wrong time where I'd have to sacrifice some other things that just aren't negotiable right now? Okay, so those are all other questions to be asking. So let's say that in like this last scenario, good product, person doesn't already have it. It will definitely improve their financial situation and they can afford it. It turns out they were overspending here, but they could put something towards this and then yield great results. Okay, the XYZs all make sense. That means it's a yes. The anxiety is moved away because it's not an anxiety around, ooh, is this person tricking me? Is there something I don't understand about this? The vectors, they're strong. It's something that is a little more tangible because it's not just about surface numbers, because numbers can be manipulated. It's about how does this fit in the context? What are the moving parts? What are the momentums? And it stood up to really close scrutiny. And there's this internal logic as to why it works. It makes sense why this works. Okay. And it does fill in gaps and it has been evaluated against other similar offerings or opportunities so that it is best in class. Because even within any financial topic, whether it's crypto or real estate or insurance, there's going to be opportunity and then there's best in class opportunity. Okay. And engaging with best in class opportunity is really how you create the biggest yield or the biggest ROI for yourself. Is trying to discern and find best in class, not just any opportunity. All right, we're almost done through the tough part. When looking at risk and reward, which is any investment opportunity, right? I mean, you can keep your money under a mattress. That is no risk. The reward is you still have your money under a mattress. Problem is inflation is eating 9% of your money even while you sleep if it's under a mattress, right? So it's important to take some risk, typically just in life and also in money, calculated risk. And I love to look at things in this matrix. There's low risk, low reward, low risk, high reward, high risk, low reward, high risk, high reward. So in life and in money, high risk, low reward is like, it's like, I don't know, it's like bungee jumping or driving at night with the headlights off, right? Like you might get a big thrill, but like, is it really worth it? It's a very, very high risk. So unless that is super important to you, and for some reason that's considered a high risk, high reward activity, it might be a no, right? If it's low risk, low reward, it's like, why bother? Really? It's like going to be a lot of energy and there's not even that much to come from it. And like, is it worth putting the energy towards something? So the sweet spot is something that's lower risk, low risk, either in, I like products that have guarantees. That's my thing, because I love low risk, high reward. So guarantees, that's great. Or low risk in terms of you've done so much due diligence, you've discerned so well, it comes through such a vetted resource and has such a terrific track record, or other ways in which you believe you've created a lower risk, structure around it, and the reward being very, very high. Those are the ones that are really worth moving into action and not being as afraid. Because remember, all risk requires a little bit of a leap, okay? And then high risk, high reward, in my book, and I do think for those that are most successful financially, they're a sometimes thing, not an always and not an often thing. Because high risk, high reward can quickly part you with your money, unfortunately. Venture can be very, very high risk. And we've seen deals where, it's great returns on paper, 30% or better, but there are no guarantees and there's risk, right? High risk, because at the end of the day, if they fail, you might be completely out of luck, right? So those are great to add sometimes, because you can't go getting 30% in most other opportunities. But you can't go fill your whole portfolio with a bunch of high risk, high reward, because the chances of success on them is I don't know, maybe 20 to 30%, or something. So padding a portfolio with a lot of low risk, high reward opportunities, and maybe a couple calculated high risk, high reward opportunities, is a great balance, in my book, in my opinion, for those of us that are trying to learn how to take some steps from keeping it under a mattress and doing nothing out of fear.
Yeah. So Jennifer, I think, for some other examples of some of these, so like a low risk, low reward would be a bank account, right? Like that's low risk.
Yeah.
Debatable with what happened with the banks. Let's just say that's low risk because it's guaranteed, but low reward, especially if you still have money in one of the big banks that's still only paying you like 0.25%, because there are high yield bank accounts now at other financial institutions. So this is thanks to obviously interest rates going up. So that's an example of a low risk, low reward relative, right? If you're getting 0.25% at your Wells Fargo and 4% at like a Marcus or a Betterment or a Wealthfront, then, this is where you have to do the thing where you're just like, relative to what? Right? Those two things relative to each other, it's a pretty easy decision. I'm going to put my emergency fund in the higher interest bearing account, and then I'm just going to keep a little bit in my checking account to pay off my credit card, et cetera, things like that, my bills. So that's like a low risk, low reward example with investments, maybe certain kinds of bonds. Like even with a bond, you can have like an A graded bond, which is lower risk, and it comes with a lower reward. This is on purpose because technically, right, in investing, the higher the risk, the higher the reward. Not always true, but this is technically the way it works, where again, we go back to time being this ingredient. And so you can also get junk bonds. Now, those are going to have higher returns, higher yield, but they're higher risk. So again, this is what we're talking about, what Jennifer illustrated so well with this like low risk, high reward with the certain types of life insurance that she knows so well is there's a portfolio and you have different amounts. This is like asset allocation. You have different amounts in different things. And when it does come to venture, venture can be for some people up to 10% of the portfolio, and others who are in venture that do it for a living, they probably have everything in venture because that's what they do for a living. For most people, you can do 5 to 10% because the potential for the reward can make outsized gains that boost your returns, but most of your other money is in something relatively safer, right? So it's always that question, relative to what? Relative to what?
Totally. And I will say Warren Buffett's a master of this because he takes on risk in the market. He likes to invest in companies, but he's very calculated and he tends to be a little bit more risk averse, even though he's obviously in risk actively. And he actually uses quite a bit of products. You'd be surprised how much insurance he has and how many things he does at the end of the day to also protect himself for the downside, because that's why he's so powerful. When you position yourself in this way, you can afford to take on calculated risk. So I don't see low risk, high reward as calculated risk in my book, because I'm not a person who would put money under a mattress. My risk barometer is already a little bit more active than that. I'm like, oh my gosh, I know I've got to get ahead. I've got to leverage somehow. So a low risk, high reward for me is fairly safe. It's, for me, it's something with guarantees that I'm like, well, this is just, this is like a structure that it's not so much risk, it's more self-discipline, right? Then the higher risk stuff would be the stuff like the venture stocks, stuff like that, where I know that, it's going to fluctuate. But because I've positioned my worst case scenario a little bit, I can afford some of the differing results that will come from my higher risk opportunities. And that way you can continue engaging in risk, which is, to your point, AdaPia, pretty important for growing wealth, right? If you just hide under a mattress, it's not going to grow at all. So, it's fun to play with that idea, and you make it yours, and you understand your tolerance for risk and what low risk is to you. But it's just a helpful matrix.
Yeah, and so this is this to wrap up. This is just some basic measures, right? The 6 things to consider before investing. The first one is have a plan. It's like everything, right? Like we need to have a plan. There's the haphazard, I'm going to put something in here. That sounds really good. That looks really good. It's really important to, if you go back to that risk matrix of what's low risk, possibly low reward, and liquid, right? That's part of it. What's a little higher risk? What are the different pieces? So you have to have a plan first and foremost. Reviewing your time frame and your risk tolerance. So using time as an ingredient and your risk tolerance, because if you feel really uncomfortable with the ups and downs of the stock market or, other things, or you don't feel comfortable, let's say in venture where it might take a while for that return to come through, then that might not be right for you, right? At least not in a large amount. So that's a really important thing. Consider where to invest your money. So this could be said in a different way, like asset allocation. Like I really like real estate. It's something I understand. So probably for me, and truly for me, I have more money there than I do in other things or relative to other people. So you have to consider based on who you are and what you know and what you want to spend time on, where to invest your money. And then if you're working with a planner or an advisor or someone in life insurance like Jennifer, or a business manager, you can understand where. There's so many different places to put our money. There's truly it's almost infinite. There's so many places. So consider where based on your time frame and your risk tolerance and the amount of money that you have. So when you're planning your investment strategy, there's going to be an element there of how much do I have or how much will I have over time. The investigating how is there's myriad ways of investing. Like if you like the public markets, you can invest directly, right? Like a stock. You can invest directly. You can put it in an ETF. You can put it in a robo-advisor. You can buy options. Like there's so many different ways to do that, just as there's so many different ways to invest in real estate. Private equity, not so much, because it's really, we're talking about this next month, it's really excluded from most people's really their reach as investors. So the how is like really getting into all the different ways that you can invest. And then, this is the last two are really the big ones that we talk about a lot, is like researching the investments, like understanding what they are. Your risk, I find that risk tolerance has a lot to do with knowledge, right? If you don't know about something, you're generally speaking, unless you have a big appetite for risk, you're an adventurer. But if you don't understand it, most of the time you're going to say, that's too risky for me. So do like this self-learning, the knowledge, the understanding of it. This is the mastery of yourself. This is the mastery of, I want to understand what this is so that I can make an informed decision because I may be leaving money on the table because I'm risk averse, but it's because I don't know enough about it, right? Like Jennifer went and she did all this research on all these different products so that when she speaks to people, they go, oh, I didn't know that's how that worked. I thought all insurance was bad and salespeople, the whole thing everybody gets, right? Like, so understanding and knowing, and my husband does this too. It's all, he says, I will say no to something I don't understand, just straight up. Just straight up. He says, no, I don't understand it. That's a no. But once he does, then there's the learning piece. So the research is really important, the investments and markets, depending on what you're doing. And then the last one in big caps is due diligencing the provider. So the provider in private investments is maybe your fund manager. It's the person running the real estate investment. It's the, even maybe not so much the stockbroker, although if you're doing that, like, yes, a stockbroker, if people still use those these days, but also like Jennifer's doing the provider. She's due diligencing the providers.
They have ratings, they have track records, they have number of assets under management. There's lots of vectors you can look at with anything. Even stockbrokers, you can ask them, what's your historical performance rate for the last 5, 10, 20, 25, 30? If they don't have that data, they're not a good stockbroker anyway. So they would have that info,
Yeah. So these are things, these are how we come to understand our own metrics too. And here's where I'm going to use a term. So if anyone's heard the risk-free rate, so the risk-free rate is actually where we want to begin when it comes to understanding whether we want to put money into something. So what do I mean by the risk-free rate? That's the rate of return that you can make by taking zero risk, which has historically been government bonds, treasury bills. That is like guaranteed for that percentage amount, for that yield, that return. So if you can get 4% risk-free, okay, that's your risk-free rate. I can get 4% risk-free. So when I'm looking at an investment and it's saying, oh, I'm going to give you 6% annualized, that delta, that's a 2% difference, which you can say, oh, that's 50% more, right? Like how you say data, but it's really only 2% more. And what if that 2% for that 6% return gives you a 50% risk of loss? Is it worth it? And that's before tax. Okay. So this risk-free rate is really important in a high interest rate environment like we're in right now. This is what's happening a lot in the markets where professional investors they threw all their money into government bonds, because why would they risk their money on something that would only make them a little bit more? Not worth it. And we need to make the same kinds of decisions for a lot of people, leaving it in a 4% high yield interest rate account for now, right? That'll change when interest rates go down, et cetera. But for now, that's a great place. Why would you go take more risk during a volatile time? Unless you have some kind of guarantee, or you really trust the person, or you have a very long-term view, right? I'm going to go back to venture. Venture is a long game. Venture is a 10-year game with 20x, 50x, sometimes 100x. So you don't want to put everything in that, but you might want to put something in that, especially if you find really good reason for doing venture. You might want to have. Yeah.
Oh, sorry. I'll add to also the other consideration is the tax leverage. So different kinds of investments have different tax consequences. So that's the only other thing you might think about is tax and time, like you just said, tax and time, and opportunity. But I agree with you. It's so good you're pointing out about the high interest rate environment right now, because this is a different place than we were last year, right? Last year, you can get like a 2% didn't exist anywhere. People had to start trying to deploy their money into something that could grow it. Right now, it's more like a sitting pretty, right? You can be getting 4%. So you can really take the time to evaluate, is something worth it? Mm-hmm. From all those angles. Sorry to interrupt, AdaPia. I just wanted
No, it's fine. That's exactly right. Like you're after tax. And then you get into complexities around, well, it's not even a complexity, but when you have bond interest or bank account interest, that's taxed at your nominal rate. That's taxed at your income rate, which is much higher than if you have your yield or your return coming from dividends, that's taxed lower. And then if you have return coming from capital gains, which tend to be a longer term investment, those are taxed less than anything. So there's those vectors as well that are the tax, or like when you bring the tax piece in, then you have those vectors to think about as well. So there's the, your time frame, right? Like short term, how much do I want to put in here for short term? And how much do I want to deploy into things that have a longer time horizon that will give me consistent returns? Because one could say, well, what if the Fed, drops rates by half next year, and I went from making 4% to making 2%, but hypothetically, I invested in a 5-year real estate syndication that's paying me 5% for 5 years, right? Then, right, it's always going to be relative. You have to, the vectors are really important. And it can get like a little bit much in the head, but that's why you go back to consider where to invest your money. And that the slide before where you have like the different quadrants, and you don't put everything in one quadrant, right? So these are some of the things.
Yeah. And I do just want to add, there's one other thing. There's the regular income, and then there's ordinary income, there's getting down to capital gains, and then there's non-qualified deferred. So where if it's like a Roth IRA where you pay the taxes, but then later the gains are all free, or insurance products are like that, where you pay with post-tax money now, you pay your taxes now, but those are all tax-free down the road as well. So that should be another topic we do one day, I think, on just like taxable investment types, AdaPia, because I think that's something that people also don't think about anywhere near enough when they come to diversify. Most people are just in their 401k, which is literally all of it, all taxable at ordinary income when they get into retirement age, which is crazy to be setting yourself up like that. But we'll get into that on another time, because I definitely want to have time for some Q&A if possible. Really quickly, this is, our motto over here at Women of Wealth. And hopefully this is helping you feel a little bit more confident and shifting into getting your money working for you. These are also some of our credos. And if you're interested in being involved with WOW more closely, we partner very closely with Leadership Global. Those of you that are members, you have some automatic access and some opportunities for discounted participation in WOW. And if you're not in Leadership Global and you'd like to be part of WOW's community, reach out to us on our website. You can look at different ways to stay in our orbit as well. So you can be in our mastermind, you can be a supporting member, or if you love what we're doing and you're perhaps part of a corporation that wants to move the needle for women becoming more fluent and masterful with their money, we're always looking for donation support as well and sponsorship. We are a nonprofit organization. We do all of this for free. As you know, you didn't pay to attend this webinar at all. So with that, maybe we can open it up to some Q&A. And I don't know, do we need to stop recording for this part, AdaPia?
Not when we do the webinar, because it'll come through chat. So if anybody has any questions for the last few minutes, we can do it in chat.
Great, that would be amazing. Would anybody please ask a question? We don't want to just talk at each other. We really want to converse with each other.
Or you can raise a hand as well. This is a big topic too. So,
yeah. I guess I want to ask a question. Does this idea of vectors, because I know we got pretty dense. I told you this wasn't going to be lightweight today. This was getting into the meat and potatoes of things. Did that idea of vectors make any kind of sense to people at all? Intuitively, did it resonate at all for anybody? I see.
Yeah, Amy says it's a new idea.
Okay.
Yeah.
Thank you. Well, it's that X-ray vision that I know. I see this from the women I chat with, that they're the biggest fear, and this is well documented among women in general, is that I don't know enough to know. and I don't know enough to decide. And so obviously, this is just one webinar, but we really want people to feel like they can start to understand how to approach their own sense of an XYZ coordinate, and that it's not something that's out there from someone else. It's something we have to cultivate within always, because we can put ourselves in the hands of a quote advisor, and we will always only be at the mercy of that advisor's good intentions and knowledge, which is, risky at best.
Yeah. And I think it's important too, when we look at like different metrics, and like I said, they're really used to make an informed decision, an informed comparison. And it's a little different. It's maybe more on the asset allocation side, but there are so many different ways to invest your money, and there's always another opportunity. So kind of going back to maybe your internal compass. If something is a no, like my husband, he's like, I don't understand it. That's a no. It could also be, it's a no for now until I understand it. Maybe it's a yes. And then maybe it's still a no, because now that I understand it, it's a definite no, because it's just not for me. Right. So using all of these and using the metrics and the measurements to understand whether it's a yes or a no for you. This is it. Yeah. It's like gut feeling plus data is the winning combination. It's everything. It's data. And then, does that feel right for me? Does it meet my goals? So having the plan, having your goals, knowing what you want, knowing where you want to go, and then working with different investments to help get you to those goals. That's really what we're what we're talking about here, and not to let the jargon make us ever feel like we don't know. Like I'm around people who are absolute like math gymnasts in their head, and I can go like, math is not my strong. It's really not my strong suit. And I think, oh my God, I don't know what they're saying, because I really don't. Sometimes it's so fast. I'm like, I don't know what you just said. You need to talk to me like I'm 10. Because and so sometimes we can get gaslit. And I'm not saying that these people I'm talking about are gaslighting me, but we can by people who have bad intentions.
Oh yeah. And that's why there's no stupid questions. And so I think that's just the basics we talked about. No question is dumb. I guarantee you, the higher quality the advisor, the more patient they will be with your quote dumb questions. And AdaPia, the people who talk real fast, they're missing things, they're skipping things. They are, like, it happens. It's a very masculine way of doing business. And as we see, they make big mistakes. Entire banks have completely fallen because some poor, quick decisions were made, right? So it's really okay to take time and dig in and get a little granular always. And again, wise advisors, male or female, will always respect that. Warren Buffett takes a lot of time, for what he does. That's a great question about references for high quality advisors. It depends on the kind of advisor that you're looking for. Feel free to, what's a great way to follow up with us? You can always email AdaPia or myself, or the WOW website has a way of contacting us. If you're interested, I think the best way is to get engaged in the education, because it's not like there's a short list of 1 or 2 or 3 good advisors in the country, right? It's which is an advisor that's probably suited for your specific needs at this time. And also, how do you cultivate your ability to discern whether they're a high quality advisor, and that improves your outcome. So there are women in WOW, for example, who have started, they don't want to be advisors or do that stuff, but they at least know now how to gauge and choose more effectively, and it's a more empowered relationship. So sorry, the answer to that one's a little complicated, and we're almost out of time, or that might be a whole other topic to do.
Yeah. That's and there's some references, and there's definitely some references and referrals that people can make. I do really want to quickly answer Leah. So Leah, my personal answer to you about, for those who've recently experienced a life event such as a job loss, but have a bit of a safety net, would you suggest putting a hold on investments in this current climate? I would say yes, absolutely yes. If you can get 4% in a bank account right now until you are solidly earning your income again, yes, absolutely. Like, now is the time to focus more on short term, especially if you have a safety net, not long term. That would be what I would do.
Just make sure your checking account is actually getting you 4%. A lot of people we talk with right now are still only getting 0.25% or whatever. Go get that 4%. It's out there right now. It's not just on your pure savings.
Yeah, exactly.
Yeah. And reevaluate in 3 months once you have a sense for your vector. Are you going to be working again soon, do you think? Are you going to be working on a new venture that you're going to fund for yourself? You'll have a sense for your vector, and then you can reevaluate engagement in the market.